Hello, everyone. Hi, Steve.
Hi, Erica. How are you today?
We are LinkedIn Live right now. How about that?
That's pretty awesome.
Yeah, I think this is the first of its kind. So excited to partner with you on it.
Absolutely. Maiden voyages are meant for you and me.
That's right. How impressed were your kids this morning when you told them that you're going to be internet famous by the end of the day?
Not one of them believed that I was going to be an influencer.
Oh,
Couldn't convince them.
I'm sorry.
How about your
I've still
kids?
got kids in elementary, so I think being able to use a computer at work is our bar, so maybe a little bit lower than your high schoolers. But either way, I'm really excited to be here with you and to all of our audience. So hello, welcome. My name is Erica Harrison. I am the Vice President of Analytics at Nielsen IQ. I've spent my last 12 years here working with our major manufacturers to help solve their everyday business questions, and within the last 5 years, really focusing on price, promo, assortment, and execution strategies.
And I'm Steve Zurek. I've been at NIQ now for about 18 months. I'm a boomerang. I was here in the early 90s, and I'm the VP of Thought Leadership and have a little over 30 years of experience in the CPG world with some of our clients, our major clients. So happy to be here. I'm focused on the future and ready to answer the questions that we get today. So I'm looking forward to it.
All right. So please don't be shy, everybody. We don't want to be, the kids at the side of the dance hanging out on the wall, just wondering if anyone's going to talk to them. Please send us questions. We have a couple already, so I'm going to take the first one. This is a question we're getting from a lot of our clients today, which is what's happening with price elasticities? How are they trending since COVID? So what we saw during COVID was that price elasticity started to trend down, which makes sense if you think about how consumers were focused on things like health and safety. Last year, we saw very much the same. Again, if you think about the consumer mindset, they were sort of accepting of price increases because they had to, because they were happening across the total store. What we're starting to see in the last couple of quarters is that elasticities are trending back up. They're not quite to those pre-COVID levels yet. But one of the things we also like to do at Nielsen IQ is look back in history to help us predict the future. And when we look at what happened after the 2008 recession, elasticities kind of behaved in this same similar manner. What I think is really interesting about what we're seeing in the most recent data as you look at elasticity trends is we like to break down elasticities into three components. How tied are you to your own pricing, to your internal portfolio pricing, and then to your external or competitive pricing? What we're seeing over these last couple of quarters is that competitive bucket is starting to grow in importance. And again, if you think about yourself at the grocery store, this makes sense. So as you've seen prices increase across the total store, you're now starting to pay a little bit more attention to things like private label or brand comparisons. So I think the learnings for you out there in the audience today is that starting to track your competition, if you're not already, and what they're doing with their price is going to be really important in making sure you're managing to any of those critical gaps between you and either branded or private label competition. All right, Steve, awesome. You want to take us to our next one?
Yeah, we're getting some good questions here. All right, so the next question is, there are new price points. Really? Did we go through inflation? Yes, we did. If we were promoting generally at $9.99 in the past, but retails have gone up by 10%, it's no longer feasible to get down to that price point.
Sure.
You are absolutely right. It is not feasible to get to that price point anymore. But in the work that we've done, and this is before the pandemic as well as after, we've looked at a lot of elements of promotions and what drove performance. And while price is generally that lever that we like to gravitate to, and it's the easiest lever to pull, really what we found is that it was the way the promotions were executed and the level of support that those promotions were getting within the retailer. So, if you had a promotion that had good display support, you were favorably placed in the feature, You had digital support. You had that 360 kind of execution. That's really what drove performance. When you start looking at what's going on in the market when you're promoting, you want to understand what your competitors are doing. You want to understand who was on when you were on. Were there some competitive forces that were at play that were also playing with your ability to lift or not lift during that promotion? But in reality, we're all here to make money, right? Going into the pandemic, trade spend was not that efficient. It was not returning. But if you can look at some of those elements of support that your best promotions were getting, that gives you a negotiating point with your retailers, because they want more money in their pocket, and that will in turn put more money in your pocket. So I hope that answers that question.
Yeah, I think that's such a good point, Steve. And something else that kind of calls to mind when you're thinking about comping promotions year on year is that's where I feel like internally it's really important for organizations to work cross-functionally, because you've got maybe an RGM team that's helping set up those promotions. You've got field sales teams that are really close to the retailers. And so maybe it's something crazy like a competitive retail outlet opened down the street of the store. And so your promotion didn't have the same effectiveness because now there's more price comparisons going on within a consumer's kind of zone of which they shop. So really important parts there. Yeah. You're also taking us a little bit into promotions, which is great. So I'm going to pick up a promotion question, which is, how do we test new scenarios when it comes to promotions? And I think there's kind of two important components to this. The first is before you get to market, how do you make sure you are introducing the most effective promotions? So there's a lot of different ways, depending on which tools your organization has access to, that you can do this. But I think the biggest part is you've got to do that homework. So if you are looking at basic scanning data, you can understand what was done in the past, how was it done differently by different retailers, what was the lifts by different PPGs or UPCs that you may be looking at within your database. If you have the benefit of more of an advanced solution like a pricing and promo scenario planning tool, that is excellent for being able to test out different hypotheses. Because what's really nice in that scenarios, you can also plan what's happening with competition. You can play around with frequency versus depth. And so really trying to figure out that optimal mix before you even go to market. In addition to that, it's really important to measure what we've done and to see if we had our hypotheses kind of come through in the marketplace. And so as you implement new promotions, make sure you're going back into the data and you're understanding whether or not that was more of a positive lift, not as positive of a lift, incorporating things into your analysis, like Steve mentioned, of what's happening with competitors at the same store, if you have that benefit, if not at the same retailer, what's happening with other categories, even looking across the total store. The more information that you have, the better. But I think the message is nobody wants to be wasting trade funds. We all put way too much money in the marketplace and don't see always the return on those that we'd like to. So making sure that you have a way to go back, test those scenarios in advance if possible, but if not, definitely afterwards to see if you were moving the needle or if you need to course correct, maybe shift to a different brand, a different retailer to execute on the next time.
Yeah, when I was on sales teams, and most of my career has been on sales teams,
sure.
It was difficult sometimes to be able to do analysis on an ongoing basis, especially if you were responsible for multiple brands. You had a high frequency brand that, it was very difficult to do that consistently on an ongoing basis. And, I think now there's capabilities that allow sales teams to do this kind of analysis, the postmortems, much quicker. And really, the reason you need to do the postmortems as quickly as possible is because you need to know how to course correct. And if you don't have a tight hold on what's going on with your trade, you could be into your next quarter and realize that you're going to run the same promotion over again, and you don't even know how it performed the last time. You got the bill for it, but you really don't know what what it did. So that's
Are
really.
you saying that there's more predictive power tools in the marketplace since you've been an analyst, Steve?
There is. I wish I had more scenario based planning stuff so that I could see, what was going on before I actually put it in market.
Yeah, sure. All right, what do we have next?
All right. So the next one is the increase in promotions in the last year largely driven by big brands within the category? Ooh. Okay. That one's a really, really interesting question. I think it varies a lot by category. Some of the big brands just did not have the ability to stay in stock, and then had ongoing supply chain issues. So, when you've got out of stocks, you're not going to be promoting. So, in that scenario, big brands were not driving promotions. But what you can do is you can look at the POS data, the RMS data that you have to see, has frequency changed? Has depth changed? Are there more manufacturers promoting within the category? And then that would be more helpful in kind of answering this question. The other thing to know is that, you want to be able to show volume growth or loss due to promotion. We talk a lot about subsidized volume and trying to get that as low as possible so that you're driving incrementality. It's really about analyzing, your POS data and looking at those causal pieces to really understand what's going on in the market in terms of promotions. And promotions are still, they're below where they were pre-pandemic. They're starting to creep up a little bit. So it's a good question. It's definitely something to be looking at.
I think sometimes too, retailers are using the smaller brands to kind of disrupt. So now that we're seeing more shoppers come back into the store, how are they getting attention? How are they driving traffic down certain aisles? So I agree with you, Steve. I think that one's probably a little bit of a mixed bag depending on the category and even the retailer.
Yeah, boy, I would say that, being a small brand right now or a medium-sized brand it could be an interesting and a frustrating point in our CPG history, because they're small and medium-sized brands are the variety of every category. And, you may have a tremendous opportunity right now to be adding that variety, adding the incrementality that, big brands just can't.
Yeah. And I think too, with kind of the return to stores, that's almost an advantage. I think about, for a while, I was strictly shopping on Instacart. And so I was kind of on that autopilot buying brands that I know. But now that I've gone back into the store, like, oh, look at these new category entrants over the last couple of years. So trying and seeking more variety is certainly something I'm personally experiencing.
Exact. And seeing the raised eyebrows and the big eyes of discovery is even better.
Yeah. Okay, so we got one that's a little hard to answer, but let's attempt it. So what do you do when a retailer insists you do more promotions or you're discontinued? So the threat from the retailer. And obviously, SKUs being discontinued is kind of the kiss of death. So we all want to avoid that and try to keep the space on shelf as much as possible. Honestly, there's really not an easy answer to this question, but you came to this session to ask a data company our opinion, and Steve and I, if you don't mind me saying, are a little bit of data geeks. So what I would say in answer to this question is you've got to lean back on the numbers. So retailers want to grow, and in most cases, they want you to grow too. So I think trying to come up with kind of a common set of objectives and goals, number one, as well as KPIs for how you're going to get there, and then showing them data to maybe refute or maybe twist a little bit of what that ask is. So maybe you're not going to be able to execute exactly what you had hoped, kind of with the retailer's wishes, but can you come up with some kind of compromise that's going to lead to a win-win solution? There's something that we have within kind of our toolbox that I've been talking to a lot of clients about lately, which is called promotional source of volume. And what it does, it kind of gets to like a true incrementality number by looking at sort of breaking that subsidization piece down and also adding in a component of cannibalization, both from a manufacturer and a retail perspective. So said really simply, what it's doing is it's helping identify the promotions that you're running that are beneficial to the retailer, because it's keeping the consumers, the shoppers within their four walls, and it's beneficial to your brand. And I think if you're able to leverage that, or even some of your scanning data, just to show the retailer that your strategy is going to lead to more of a win-win and help their whole category grow, that might be your best bet to combat a challenge like that from your buyers. All right, Steve.
All right. I always love the retailer threats.
Like, oh, I don't envy you sitting in that seat.
No. There's a little PTSD there that I'm just trying to push right down. All right. So the next question. You need to grow units. Otherwise, other brand competitors are going to steal share. Also, retailers will not allow trade spend to be reduced as a percent of sales. How do you structure promotions to overcome these factors? Wow, that's a lot in that question. So I assume that when you say you're going to grow units, that is a KPI for your company, which is, it's a good KPI to have actually. But what you need to understand about that KPI is that that can come at the expense of margin. So, if unit share is important, you're definitely going to want to increase promotion frequency. And there is a little bit of a balance there, because you do start to see diminishing returns if your frequency gets too high. So I'll share a personal story there. I knew that my brands in the OTC pharma space, that once I got over 15 to 17 item promotions per year, I saw a dramatic decline in my returns. So I would usually leave like 10, 20, even 30% of my promotion schedule kind of open so that I could test some different things, and eventually I would end the year with 17 or 18 promotions. But once you get to that diminishing return, you don't want to continue to do that, because then your retailer will start to expect that. So the second part of your question, retailers don't want you to reduce your trade. In fact, there is a push-pull that's going on there. You don't want to spend as much as they want you to spend. And that's always been that headbutting that goes on. But you can always change where you invest your trade. So, maybe you want to start looking at ranking your promotions. And so in the presentation that we had last week, where we showed how you could look at your top promotions and your bottom promotions, you definitely want to start looking at those and weeding out the ones that aren't performing, the ones that maybe cost too much and don't return enough to overcome your investment. But, once you start doing that kind of work and that analysis, and you're able to make decisions that are rooted in data, they're optimizing your trade spend and they're optimizing the performance of the promotion, then you're going to naturally get retailers on board, because you're going to be growing their category, and you're going to be growing their margin.
Win-win. Okay. We've got 10 minutes left. So first of all, I just want to thank everybody who has submitted questions. Please keep them coming. Eric, I'm going to take yours next. So thank you for being a brave soul. But Eric asked us about what is the ideal time frame to have a promotion live in market. So I guess the obvious thing that I would say is try to align your category with seasonal events. So if you're playing in chips, beverages, etc., something like, a football season kicking off is great. If you're playing in over the counter, something around flu season, etc., is great. If you're playing in something like paper, pencils, back to school. So all of those kind of obvious occasions where people are going to be in the store and looking for categories such as yours, try your best to make sure that you're very present during that. Outside of those kind of key windows for your category, I think the most important thing to consider is the purchase cycle of your category. So it's going to vary by everybody, but knowing what that cadence is that shoppers are on in terms of when they're coming to your category will help you understand kind of how far apart you want to pace some of those promotions. So for example, if your purchase size is every 3 months, you're only promoting every 4 months, then you're sort of missing that opportunity window where people might come back and be willing to try another brand that is on promotion. So that would be something that I would look at if you haven't already, in terms of figuring out kind of how far apart to space your promotions. And then again, just taking advantage of any of those natural windows where consumers are going to be in store and more apt to buy your categories.
The one other thing I would add there would be, there's this idea that if a promotion is really hot, you may be advancing forward a future purchase. So you're kind of financing a future purchase from that same shopper. And so if you're doing that, one of the things you have to be conscious of is, are you going to take that person out of the market for the remainder of the year? Say going back to OTC pharma, you might have somebody that buys pain medication one time a year. So if you give them a really hot promotion, you're going to take them out and they buy two bottles. You could be in theory taking them out of the market for a couple of years. So you just want to figure out, if you're going to do that, how are you going to continue to add incremental purchases throughout your promotion schedule so that you're not actually just advancing stuff forward, somebody's loading up in their pantry, and then they're out of the market for the rest of the year.
Steve, can I tell a really funny story in 10 seconds? Since we are live and we're doing this for the first time, I just got the pop-up on my computer that it's going to force restart, and luckily it let me postpone, but that is a funny thing from the universe right now.
It always happens during
all of a sudden I disappeared, yes. Okay, I'm sorry, I kind of lost track. You want to take the next question?
Let's see. So the next question is, what is your promo ROI calculation? Okay. So people will do that calculation differently. There's as many people that are thinking about it is the variance that it could have. But generally speaking, you don't put your fixed costs in there. You don't put your corrugated costs if you've built displays. You don't put your the costs of the program, the fixed costs, but you do put in what I would use is incremental promotion dollars minus cost of the promotion over cost of the promotion, and that generally gets you to the ROI for that particular promotion. And I would say you just have to keep doing that, because that one number in and of itself may not necessarily mean anything. It's really, when you start comparing it to other promotions, obviously a negative number is not the number you want to have. But in some cases, I used to call on Kmart, so I got really good at calling on, well, it's less negative, or it's less negative than this other promotion. But generally speaking, you need to have a few of those in the hopper before you can really understand, okay, this is what my trends are. This is how I'm going to set, my KPIs going forward.
Mm-hmm. Okay, everybody's starting to feel really warmed up, I think. All of a sudden we had them trickling in, and now we have several, which is great. So I'll try to be maybe succinct so we can get through the next couple. How do promotions affect brand building? In my opinion, they absolutely do. I think there's a lot of, things we can do within the store to not only help give, a little bit of a discount, a little bit of an incentive on a brand, but it's trial, number one. It helps maybe somebody who wasn't willing to try your brand or wasn't aware of your brand previously, a reason to do so. That's a little bit of a lower barrier to entry than maybe if you were still on your everyday price on shelf. I think the other thing it does is give you more real estate to tell your story. So if you think about having a secondary display, maybe in a different part of the store that you're not traditionally in, you're getting new kind of eyeballs, if you will, on your brand. You're getting real estate to be able to promote a tagline or a claim that is important to consumers. It can help reinforce any media messages or any shopper marketing that's helping or that's happening in the market or within the store at a certain time. So I definitely think there is a lot of brand building and sort of equity reasons why promotions in store are helpful in that area.
Yep. We have another question. How should we run or do promotions without creating trade-off effect for BAU sales, since we want to make sales on both special occasions and a daily basis? So the first thing is that, if you want to drive conversion, the first thing that you really need to be looking at is what does your shelf look like? What is the holding power of your brand at shelf? Because if it's not on shelf, you don't have that billboard there. You're not there when that everyday shopper is going to be walking by the set. As far as creating a trade-off, you have to look at how your shopper shops your category. So, for instance, orange juice. I don't think there's anybody on the face of the earth that buys orange juice that is not on deal, because we're all trained to bridge from deal to deal to deal. So right there, that concept is the one you want to avoid, because there is no base volume in orange juice, or it's very little comparative to other categories. So if you start training your shopper to just wait for the next deal to come, and it comes on a fairly regular cadence. And right now, let's be honest, shoppers do not know what the cadence is, because the cadence hasn't been there for 3.5 years. So they're starting to get to that point where, they're going to be paying attention to what the deals are, and they're going to start getting a sensitivity to what a good one is versus a not good one is. And they'll eventually get back to fighting strength with that concept. But don't train your shopper to bridge from deal to deal. Otherwise, you're going to be just subsidizing base volume, and you're not going to be driving any incrementality to your brand.
Yeah. All right, Steve, we got 2 more minutes. I'm going to squeeze in one more question, and then I want to comment on another question that we got in terms of being able to follow up. So somebody asked the question around, consumers being kind of creatures of habits on autopilot when they're shopping, and how do you disrupt with promotions? So a huge message that I hope you guys all hear from us today is that now is absolutely the time to change it up. So we've talked a lot at Nielsen IQ about this kind of being the year that has been a once in a career opportunity to hit the reset button on promotions, and not just lift and shift what you did in the past because it's what you did in the past. So if you take nothing else away from today, it is please go reevaluate your promotional strategies, because it's a great opportunity to kind of get rid of that dead weight that maybe you don't like to run in the past, but again, your retailer just expects it, and really challenge and think differently about how you're putting more productive, effective promotions into the market. The other thing I'll leave you guys with, I know we didn't get to every single question. Troy, you had some good ones around discretionary categories and when throughout the month is best to promote. So we can follow up with you after this webinar. Again, if everybody else, if you didn't get a question answered, please let us know. We're happy to follow up. Also, there was a 2-parter on Troy's question that I think might be beneficial to everyone around how BOGOs impact brand equity. And again, I think some retailers like Publix, that's just their MO. So you sort of have to get on board with that BOGO idea. I think the other thing to think about is that whole pantry loading aspect we talked about earlier in terms of a purchase cycle. And if you're buying more of a product, does that mean you're going through it faster? Or does it just mean that it's taking you out of that purchase cycle for longer? So if you're playing in a category that is expandable, Think soft drinks, for example. Beer is another good one. The more I have in my fridge, the more I'm going to drink. Then a BOGO might not be a bad thing for you because it is encouraging overall that buy rate and increased consumption. If you're not in an expandable category, just be careful about when you're executing them, because while you will get a really big lift, it might take that consumer out of the cycle for a little bit longer. So, all right.
All right.
I think we're at time.
We're at time. We made it through the very first inaugural.
This is great.
Live.
I think people asked us to dance. I think it worked.
I think so.
Perfect.
Thank you, everybody, for your questions. We will be following up with the ones we didn't get a chance to answer, and look for more of these coming from Nielsen IQ or NIQ in the future. Thanks,
everyone.